I want to start with your opinion of today's change in the cabinet, not the cabinet, but Council of Ministers. What do you make of it? Just plain politics, or you see something that is going to change which will make any difference in policies?
I think it is essentially plain politics. And what we have seen from this government is that anyway power tends to be concentrated in the PMO. So I don't think even if you have very strong independent individuals appointed in the cabinet, they will be allowed to do much independent actions, because everything seems to be dictated by the PMO and monitored by the PMO.
We are hearing, although the details will come out later, that the Corporate Affairs Ministry will go away from Mr. Jaitley, INB will go away from Mr. Jaitley. Does that leave him with more time to focus on the Finance Ministry, or does it mean that the PMO now intervenes a little bit more directly into corporate affairs?
So I think anyway in this government, the PMO is everywhere. In fact, in all ministries, whether it be in very critical ministries, even like foreign affairs, where he seems to be in the driving seat. So it appears that things have become less for Mr. Jaitley, and if what you say is correct, he can concentrate on the finance ministry. Now, in the press also, there has been some criticism of his policies and the attention that he's devoted to the finance ministry, but it seems he enjoys the confidence of the PM. And therefore, I think he'll be allowed to be there.
Let me take you up on a CMI report which has been released, and I'm sure you've seen that as well. We were speaking to Mahesh a short while back, and he was saying that in the first quarter of this fiscal, we've seen the worst ever performance in terms of new projects being completed, new projects being launched, and the number of stalled projects has also gone up sharply. Now, some have blamed Mr. Raghuram Rajan for this. I understand that you have a different view.
See, I don't think one can blame Raghuram Rajan for the capex not reviving, because that is really a demand problem. You can say that he's not implemented policies which could have been more conducive for reviving the economy or easing the pain, like lowering interest rates. For example, in the beginning of his tenure, he used to always talk of real rates of interest. Now, surprisingly, in any of his speeches or any of his the writings from RBI, you don't hear him talking of the real rate of interest, because it has been a very positive real rate of interest, and yet you find that financial savings in the economy are not picking up. Capex is not picking up, and this was one of the central thesis of the monetarist school, that you can have revival only if you have real rates of interest, and therefore deposits will go up, savings will go up, and therefore capex will happen. Now we are having real rates of interest and nothing is happening. So something has to be really questioned, or the basic tenets of the monetarist policy.
And we've discussed this in the past, and I'm seeing that again this thing has come back, and that's the issue of fiscal deficit. Now, Raghuram Rajan was entirely on the side of the government when it comes to targeting fiscal deficit, an obsession in a sense with inflation targeting. Some like it, some don't. And fiscal deficits was part of that as well. The reason why we are not seeing a revival, many argue, and I would be one of them as well, is because government spending is not really aggressive.
Oh, most definitely, and this has been my position for nearly 2 years now, which is the classic Keynesian view, that in a demand slowdown, if the government also contracts its expenditure and its fiscal deficit, you're only going to make the situation worse. Because in a slowdown, there are two entities which can play a truly counter-cyclical role. One is the central government through expenditure, and the other is the central bank, the Reserve Bank of India, through monetary policy. Yeah. Now, what we've been finding in India is that both these institutions have been playing a pro-cyclical role. That means they've been focusing on fiscal consolidation, that means reducing the deficit, and under Governor Rajan, keeping a very tight monetary policy. Now, when there is a demand slowdown, you have such constrictive policies, you're only going to make the situation worse. I think that is what the CMI data is showing.
So there seems to be a bit of a problem, because suppose you were sitting in the finance minister's chair, and you can't really say, I don't care about fund flows, because it has a sentiment impact, it has an impact on the currency. Now, if I say I am going to spend, and there's going to be a lag effect in the way in which growth is going to come back, and therefore I'm going to expand my fiscal deficit, The danger is that international credit agencies, whatever their record might be in being good, bad, whatever, they will put you on some sort of an alert, will downgrade you, and suddenly all the algos, all the funds which actually don't really look at you and just look at a number, the risk rating, they'll suddenly withdraw money from you, and the currency depreciates, money flows out of your markets, markets crash, and suddenly the media, people like us, start crying that this government is doing very badly. So it's a very difficult situation. How would you solve that problem?
Firstly, if you're the finance minister and you say, I don't care about funds flows, then what are you saying? I don't care about the plight of my average citizens who have voted me into this office. I think between the foreign capital and your own citizen, where should your priorities be? As the finance minister of a sovereign democratic country, it should be the plight of your average citizens. Now, if your real incomes are getting squeezed and you're saying I cannot increase fiscal deficit because there will be a funds flow, then you can always impose capital controls. Now, this again is like a big boogie. It's like fiscal deficit. You cannot expand it. It will create inflation. You cannot impose capital controls because it leads to disruption in the market. But then what do? Finally, end of the day, your job is to improve the average standard of living of your citizens. And if by following a constrictive monetary and fiscal policy, that's not what is happening. So if you have to increase the fiscal deficit significantly, because even a marginal increase will not solve the problem, you have to impose some form of capital controls, which is highly unpopular today, but that is what is required. You see, Governor Rajan also in his speeches used to preach how the US federal governor, what type of policies the US Fed should do. The point is the US Fed does not listen to the Indian central bank governor, but what is possible for the Indian Reserve Bank of Indian governor is to impose capital controls if he feels that too much liquidity is
even when he was part of their conference.
Correct. See, as a central bank governor, you can put in foreign exchange control because that's one of your main jobs. Instead of preaching what other central bank governors should do or should not do, because their policies are impacting you, you can very well, build up the, mandate for having foreign flows controls, which, mind you, foreign capital is going to dislike.
Let me come to corporate earnings, and there's a very interesting piece by Manas Chakravarti in Mint, which I would like to inform our viewers has actually been forwarded to me by Mr. Hazari, and that's how I read it. Very interesting data from RBI, which actually looks at the sales growth and earnings growth of companies and stratifies it. So smaller companies, it appears, have either degrowth or very slow growth, whereas larger companies have done extremely well, which is, of course, classic what one would expect. But that also indicates that we are increasingly going into a space of consolidation, of formation of monopolies and oligopolies in the market. Because on the one hand, you're seeing all the earnings moving towards the bigger companies. On the other hand, stressed assets are also going to the bigger companies because the banking system is actually not helping smaller companies to come out of them.
Now, if you take this data and you put it alongside the data which the RBI also released in its financial stability report, you will find that about 58% of your gross bank credit is going to the large borrowers. And out of their total NPAs, about 86% is with the large borrowers. And yet you find that when it comes to the corporate performance of those companies below 25 crores, their sales is being virtually wiped out. And I've been raising this issue for the last 1.5 years, that you should look at the smaller companies because these are the ones which feed into the larger companies. In addition, the bulk of employment, if industrial employment, really originates from the small and medium-sized sector. So if their sales are getting wiped out, there's an acute crisis going on, not only just with small companies, but with all the industrial labor that they have been employing. And if you see, the bank credit is getting totally focused on the large corporates. So a huge universe of your industrial sector is not only doing very poorly, but is being denied institutional credit, and which is shocking when you consider that the bulk of your banking industry is government owned.
Exactly. That's an interesting thing, because in the long term, you're actually ending up creating what one city report, the infamous city report called, I think, I'm forgetting what a plutocracy, right? Where a small number of people decide what consumption is going to be. So let me be the devil's advocate and say that I'm in the stock markets and I don't care whether people get to eat or have jobs. I'm interested in making money from the markets. Now, if you wore that hat and you had to advise me, would you say the best bet is to stay with big cap because that's where money is going to come?
See, most definitely yes, because in a slowdown, the large caps tend to have more pricing power. And when there's a demand slowdown, when you're not going to see much top line growth, therefore is whether your margins can expand or not. Now, today what we are finding is that the margin expansion has really taken place because of global events which is not in your control, basically lower commodity prices. Now, what is also happening is that with the laborers also you can squeeze them to a certain extent and squeeze their wages. And that's what we have really seen, because the rural incomes in real terms have been getting squeezed. So an investor in a market would like to see companies which really are expanding their profit margins, which have the capacity because they have some pricing power, whether they have a strong brand. So therefore it makes eminent sense to go in for the large cap, because smaller and mid-cap companies normally they do not enjoy pricing power. But I would just like to add that if this slowdown continues, then in the end also investors like to see growth, because you cannot have an indefinite margin expansion from lower costs. And if your real incomes in the economy are getting suppressed and if your real wages are not rising, you cannot get growth. And that's the exact problem that we are in today.
Right. Hemindra Hazari, thank you so much for joining us.